let's talk about some of the different types of accounts that you need to have. When I was first getting my money right and getting my financial education, I realized I didn't have everything together. I didn't realize these are some of the accounts I should have on my financial independence journey. But today, let's get into it. So, the first type of account you should have is a savings account. We all know that, right? This is where you put money to save. It's a great place to put your emergency fund, right? Your emergency fund is money you have set aside in case life happens, right? You get a crack in your windshield, or the transmission goes out, or there's a leak in your house, or something of the sort. It's for an emergency. So a savings account is where you want to have that, right? Now, the traditional banks, the big banks, are going to give you essentially nothing, right? 0.01%. They're not going to give you anything. A better place to put it is a high yield savings account, right? So places like Ally Bank, American Express, SoFi, you can just Google high yield savings account. A savings account, especially a high yield savings account, is an account that you need to save money for emergency, right? It's liquid, which means you can get to it right away and get cash for emergencies. Now, the second type of account that you should have is a checking account, right? That's basic. We all know that, right? This is where you operate from. So, you work your job, the money goes in direct deposit, and this is where you pay all your bills, right? All of your mortgage, your rent, your insurance. Your checking account is kind of where you live month to month, right? The third type of account that you should have is a retirement account. If you have if your job provides an employer sponsored retirement account, it's going to be something like a 401k or a 403b or something like that, right? Now, this is for your retirement. You are able to contribute funds either pre-tax in a 401k or post-tax in a Roth 401k combination they may have. But the reason why this is important is that one, it's for your retirement, and two, a lot of times your employee, and two, a lot of times your employer will match. They may match your contribution, maybe up to 5, 6, 7% of your salary. So if you don't contribute, then you don't get that match. So that's free money you're giving up. So that's definitely an account you want to have. Depending on your employer, the investment choices may differ. It may be good or it may not be so good. But a good way to think about this is to contribute, even if the investments are not that great, at least up to the match, right? At least up to the match, so you'll get that free money. So that's the third type of account you want to have. So the contribution limit to your 401k in 2024 is $23,000. If you're 50 and over, you have a catch-up contribution of $7,500. So if you're 50 and up, you can contribute 23,000 plus an additional 7,500. So that'll be 30,500 to your 401k, right? So that's great. The next type of account that you want to have is an IRA, right? Now, there's some people whose job does not provide a 401k, right? Or maybe they just want to have something extra. So a traditional, now with the IRA, it comes in two flavors. One, you have your traditional IRA, which is pre-tax contribution, for which you'll get a tax deduction. And the other flavor of IRA is the Roth IRA, which you contribute post-tax dollars. And the other flavor is the Roth IRA, which you contribute post-tax money and you do not get a tax deduction. The maximum contribution to the Roth IRA is $7,000 if you're under 50, and you get an additional $1,000 catch up. So it's $8,000 if you're 50 and up. And that contribution limit is combined. So if you have both a Roth and a traditional, and you're under 50, you can put $7,000 combined between both accounts. If you're 50 and up, you can combine $8,000, both Roth and traditional. Now, there is income limits to contribute to the Roth, right? Now, for the Roth IRA, there's income limits. If you're married filing joint, the income limit to enable to contribute to a Roth IRA is $230,000. If you're single, it's about $146,000. That's to contribute directly to the Roth. Mhm. The benefit of the Roth is that the money grows tax-free. And that's a great strategy. So you have a bucket of money later on that is tax-free. So the next type of account that we should have after you have maximally funded your retirement accounts, whether it's 401k or IRA, Roth, and traditional, next type of account you should have is a taxable non-retirement brokerage account. That's right. We should all have a taxable non-retirement brokerage account. So you don't get any tax deduction, right? And these are taxable. If you are selling shares and so on, it's taxable. But it's a great way to accumulate wealth. And because it's not a retirement account, there's no age restrictions, right? If you grow your account to a certain amount, you can sell some shares and use it to do whatever, right? It's not tied to your age or it's not restricted to retirement age. That's the benefit. So you could have one taxable brokerage account, or you could have two, right? The way I think about it, you could have one taxable brokerage account that's focused on growth. So you're putting in this account all of your growth stocks that you believe are gonna really grow rapidly, right? They don't really pay any dividend, but these are appreciating nicely. Another type of account you should have is a taxable brokerage account focused on dividends. It's not required, but it's something that you could build, right, with dividend focused stocks, right? These stocks maybe not. These stocks are not growing maybe as fast as the growth stocks, but they do pay dividends. So you will get dividends yearly because it's taxable. You have to pay taxes on those dividends. But it's also a nice account to have where you can generate some passive income, right? Now, the next type of account that you should have is a 529 college savings account. Now, this account, as the name suggests, is to save money for college expenses, right? So people out there that have children or other family members that you want to help go to school, you open one of this account and you invest in that, right? And if you start that early, you'll have a nice pot of money sitting there for when your uh, child is ready to go to college, right? You may get a tax deduction. Some states may give a tax deduction for the contribution, and when you take the money out, it's usually when you take the money out, it's tax free if it's used for higher education, right? It doesn't have to be college. It could be post secondary studies. So maybe a training program for HVAC or plumbing or electrician or whatever. So that's an account you should have, a 529. And the other account you should have, if you have children in your life, is a custodial brokerage account. This is a game changer, right? Because you can buy stocks in this account for a child pretty much at birth. As long as you have the social security number, you can open a custodial brokerage account, invest in this for your minor child, and you would be the custodian. The child would be the owner, and when they become the age of majority, some states it's 18, some states it's 21. They take over the account and they can continue. But at least you got a head start on investing, right? So hopefully you got something out of this video. Again, when I first started my wealth building journey, I didn't really know about all these different accounts, but now I believe that if you have Now, I believe if you are aware of these accounts, you can start them. You can start funding them early. Again, this is MD Investor with another video trying to increase our financial IQ so we can teach our children and break the cycle of generational poverty. MD Investor out.